In late 2025, the Federal Reserve executed 3 rapid rate cuts totaling 75 basis points. These decisions were driven by a cooling labor market and escalating geopolitical tensions that forced a shift in monetary policy. This environment triggered significant price swings in long-term Treasury bonds as yields shifted rapidly in response to conflicting economic data. For many investors, the priority shifted from seeking returns to finding an absolute baseline of stability, a way to step out of the volatility entirely. This demand funneled billions into SGOV, the iShares 0 to 3 month Treasury Bond ETF. It grew into an $83 billion vehicle designed to sit still and collect yield while the rest of the market moved. In a financial system defined by moving variables, SGOV's lack of movement functions as a fixed counterweight. SGOV tracks the ICE 0 to 3 month U.S. Treasury Securities Index. This index mandate means the fund ignores corporate debt and focuses exclusively on government obligations. The portfolio is composed entirely of public obligations issued by the U.S. Treasury. The data shows 99.99% of these assets are AA-rated, the highest credit quality available. The fund enforces a strict time limit, only holding bills expiring within 90 days, with the heaviest concentration in the 15 to 60-day window. This concentration is evident in the top holdings, which consist exclusively of short-term Treasury bills maturing just weeks apart. Compressing the maturity window changes the risk profile. As duration shrinks from years to weeks, the bond's price sensitivity to interest rate changes effectively disappears. By restricting exposure to just a few months of time, SGOV removes the duration risk that often erodes the value of long-term bond portfolios. Managing $83 billion in assets that expire every few weeks requires a high-volume operation, maintaining constant motion without creating internal drag. SGOV maintains an expense ratio of 0.09% and a portfolio turnover rate of 0%, indicating a highly efficient execution of the index strategy. This efficiency results in a mathematical severance from the stock market. SGOV's equity beta is 0.00, meaning it doesn't move with equity indices. Its effective duration is just 0.09 years, illustrating immunity to sudden price shocks from interest rate hikes. These precise mechanics allow the fund to generate a steady 3.54. Unpredictable events in late 2025, including shifting trade policies and a government shutdown, drove investors toward the safety of short-term government debt. However, the fund faces a significant challenge when interest rates fall. This chart shows how short-term yields step down as central bank cuts are implemented. Because the underlying bills expire every few weeks, the fund must constantly reinvest maturing cash at these new, lower rates, which reduces the total income distributed to shareholders. While an investor's principal remains secure in SGOV, the income stream is fragile and entirely dependent on the Federal Reserve's next decision. The bull case for SGOV rests on high liquidity, capital preservation, and its lack of correlation to the equity market. The bear case is that the fund offers no potential for capital gains, and its yield can vanish quickly if the Fed continues to cut rates aggressively. Does an $83 billion cash fortress belong in your portfolio to weather the storm, or is the risk of falling yields a deal breaker? Subscribe for more market analysis. This video is strictly educational and isn't financial advice. All investing involves risk, including possible loss of principal.